Hello, Vetted VA community. It is Hammer with this week's mortgage market update. I am joined with a guest this week. We've got James Mercado here. James, please take a minute and introduce yourself.
Well, thanks for having me on the show. Been with Vetted VA since almost the beginning. Been in the mortgage business for over 25 years, and I just really love it. And I'm a student of the business. So I'm excited to just be able to share with our community what's going on.
Awesome. Well, thanks for joining us today. Remember, everybody, if you are looking at getting buying a home, you've got vetted professionals, both real estate and mortgage professionals available to you. You can find them in your state at vettedva.com. Otherwise, let's go ahead and dive in. Today, we're going to talk about rates and the markets. And you guys probably aren't going to like me very much today. I'm going to give you a little foreshadowing. It's not our best showing. It's unfortunately not where things are. But if you're here live this morning, go ahead and say good morning. I get to see just this little thing here. This is Facebook user. So if you're here, let me know, share your name. Let me know if you're a professional or a consumer. If you have any questions, we absolutely want you to be asking your questions on the show. We're here for you guys. We're here to answer anything that you want to ask, even if it's not rate related. That's why James is here and he can answer all those questions for you. Other than that, if you're watching on the replay, do us a favor, give us hashtag replay. I know that many of you can't make it onto the live show. However, I know a lot of you do go back and watch the replay. Let us know that you were here. And again, we do monitor this post all week. So if you have any questions, let us know. If you're going to tag me, if you want me to answer, try to ask at Hammer J Helmer. It'll come up. And then that way I get notified and I'll answer it. And same thing for James. If you ask at James Mercado, he can get tagged as well. So, all right. Well, let's do a quick recap. Let's talk about what we saw happen last week. Let me pop forward a few different slides here. And of course, as we're talking about this stuff, just remember, we're talking about rates. This is not an offer to lend. And when we talk about rates, we're talking about averages and generalities, trying to give you guys the best idea of what you'll see out there if you are out, house hunting or thinking of refinancing. However, you should always shop your rate. You should always shop around, make sure you're working with a lender you're very comfortable with. So last week, I said rates could creep a bit further, but they shouldn't go too much higher unless we get some bad inflation data next week, and then rates may jump. So we're going to come back to that one. That was kind of where the most action came from, right, James? You saw that? Yeah, we had that CPI inflation data yesterday.
Well, the thing, Hammer, is we don't murder the messenger. We're the messengers today, but we've seen rates really jump a lot based on the data we're going to talk about today. So I'm excited to share it, but don't throw eggs at the monitor because we're just delivering the message.
Yeah, and I said if the inflation data was well received by the markets, it could help rates improve a little bit. And I told you guys to watch that 10-year Treasury yield for the clues. When you see that 10-year Treasury yield go higher, that generally means that rates are also going to move higher. When you see that yield move lower, you generally see rates do that. So we'll just do a quick recap. So what did happen last week? Well, rates did move significantly higher last week. And that was because of not only some of the data that we got a week past, and remember that jobs report we talked about, but also with that CPI data yesterday it showed inflation was improving, but not improving fast enough for anybody's liking. Did you happen to follow anything with the CPI inflation report yesterday, James?
Yeah, well, what happens now is when you get that data that comes out like that, the markets said, oh, so we are not doing the good jobs we thought we were going to do. And all of a sudden, boom, we see this spike in pricing. So any client that was looking at getting pre-approved 2 weeks ago or a week ago, now they realize, you better double check with your loan officer because rates did go up since that pre-approval since a lot of that data came out. So it'd behoove you to check in and find out where current markets are right now.
Absolutely. So let's talk some more about that. We did see rates move significantly. When I say significantly, I'm usually talking at least 0.25% or higher on mortgage rate. So mortgage rates moved higher, and we're going to talk deeper about this, but they moved higher in anticipation of more Fed rate hikes. For those of you that have watched our show before, we talk about how the mortgage market is actually acting in anticipation of what's going to happen months from now with the Fed. So when we finally get to a March or a May or a June Fed meeting and the rates move up, we're actually seeing the effect of that today in February because markets are already reacting to what they think is going to happen. What we have now is generally you're going to see VA rates in the low sixes. Does that sound right to you, James? Most VA loans, do you think right now are pricing in those low to mid sixes?
Yeah, that's what we're seeing in the marketplace right now. And as you know, as people remember, sometimes if you've got a lower credit score, something like that, there might be some adjustment to that. Each lender kind of has their own tolerance for risk, and they kind of build that in. So make sure it's important that you shop around, or you talk to somebody who has access to more data, so you just don't get locked in with just one specific lender, because there might be better deals somewhere else for you as a consumer.
Right. And then if you, for some reason, are not using a VA mortgage, the conventional rates are generally in the higher sixes.
Yeah.
And as much as it pains me, and I said, no, I don't think we have to worry about those sevens, I think we could actually get to the sevens. So
it's pushing, it's hitting right now. It's kind of like just trying to pop through, which is bad news, but that's what we're seeing right now.
And then, oh, you know what? I didn't update this slide, so I guess I'm going to turn that one off. There we go. I got talking to James before the show, and I didn't finish my slide deck. So talking about a rate forecast, we just started that part, James. So yeah, I mean, we haven't seen rates in the sevens since I think October. Yeah. And unfortunately, again, VA rates will be a little bit slower to move up. They generally are priced better than conventional rates for those of you that monitor the difference. And a lot of the advertising is generally conventional rates. Correct. So we're likely to see rates move up. And the reason we're seeing those rates move up now, like I said, is anticipation of what the Fed is going to do. And I'm going to show you guys that chart that I've shared with you before. This is a tool.
Make sure people are looking at this chart, Helmer, because this is good data right here.
Yeah, and this is publicly available. This is a company called CME Group. It's free data. If you can actually just look for Fed futures online. And what we're looking at is this is what markets are basically anticipating the Fed rate to be over the next few meetings through the end of the year. And a month ago, we were expecting to see that by the March meeting, rates would go up to 4.75%. Again, this is the Fed funds rate. And right now, that's still the same belief. Everybody thinks we're going to see a 1/4 point rate hike. We're not at fear of seeing the Fed start to take larger rate hikes like we saw back in 2022, where the Fed was hiking as much as 3/4 of a point every single meeting. So, I think it was 3 or 4 meetings in a row that we saw 3/4 point rate hikes. And now we're seeing 1/4 point rate hikes, smaller increments. However, what's really changed is that this is where markets had expected the Fed to pause. And the Fed members, were out there saying, hey, we think we're going to have to push rates higher. But markets, because of the data that we were seeing that was showing the economy slowing down, inflation was slowing down, markets were like, nah, we think that we know better than the Fed does. We think the Fed's going to have to stop raising rates at this March meeting, and rates will stay at 4.75 through 2023, start to come down at the end of the year. Instead now, markets are pricing in another rate hike to come at the May meeting. So we would see the first rate hike come in March, another one in May. That would bring that Fed rate up to 5%. And that's a very high expectation now. That's about 75%. So 3 out of 4 investors are expecting to see that. And by the time we get to June, we're actually now seeing I say overwhelming because it's the leader. There's a belief that we're going to see a third rate hike, which would take us up to 5.25% for that Fed rate.
Yeah. So just for like the person out here is maybe not quite as savvy, why are they doing this? Like break it down like for 5th grade. Why are they doing this?
Okay, so great question, James. Thanks for the softball, and hop in and answer that as well, because I know that you know this stuff too. So what's happened is over COVID, we talked about how during the pandemic, we dumped a lot of money into the economy. And then there was actually an overwhelming amount of spending because everybody had all this pent up demand. We wanted to get out. We wanted to travel. We wanted to go to restaurants. We wanted to live again. And all this money hit the economy. And when you have too much demand and not enough supply, it drives up inflation. People are willing to pay more to get something. And it starts out with some of the fun things, and eventually it turns into the everythings. The cost of eggs is not necessarily due to inflation. That's due to that bird flu. But the price of everything else, the price of cars, the price of, things at the grocery store. Also, we saw a lot of energy costs go up, because there was we get out there, we want to fly, we want to drive. That takes gasoline, and gasoline is oil. And we've seen now there's a big demand again for oil. So the cost of diesel has gone up, significantly. And sometimes you're not paying just to I'm not necessarily paying for the extra, soda in this bubbly here, but I'm paying to get it to the store. So the
Right.
price of the diesel for our trucking to get everything around. So all of this drove our prices up. The Fed has what they call a dual mandate. The Fed's job as our central bank, amongst quite a few other things, their primary focus, though, is to keep inflation at or around 2%. And they want to keep our employment very high. So they want unemployment to be low. So they want to keep our labor market strong, and they want to keep our inflation in a managed level where we don't have too high of inflation. Now, it didn't ever get so bad here like it did over in Europe, where it was 11%, but we were up, I think, at 8 point something at our peak, or maybe even 9. And it started to come down, but it's nowhere near 2%. And the way the Fed gets that inflation to come down is by raising their Fed funds rate, which trickles through the economy, slows down the movement of money. It slows down borrowing. It slows down businesses. It slows down hiring. And it slows that overall economy down. So we have less demand, and that'll bring everything back to a more normal equilibrium, and the prices will
Which
start
they're trying to keep
adjust.
us out of from going into a recession simultaneously.
Right. Well, that's what happens there. If they go too far, what happens is,
right. Go ahead. Sorry.
Go ahead and no. Go ahead and say what you were saying. We just blurped for a minute on the technical.
So what I've seen is, when all this free stuff that everyone thinks is free is really not really free, and that it helps attribute to the inflation. And then the next thing what happens is, if this country goes into a recession, historically, what I've seen is rates have come down historically, but this is kind of a weird situation we're in, because as we've spent way too much money, like they're trying to slow down people with cars and credit card and shopping and spending. The cost of money is so expensive now to cool us down here that it's almost in a weird time of history what I'm seeing here, because typically with the country goes into a recession, usually rates end up going down. They follow that over the course of time. But with inflation heating up, rates have spiked up high. We're not classified a formal recession right now, but I want to know what your opinion was on that, because that's historically that's what I've noticed over the years.
Well, and again, what happens when the Fed does basically raise rates, what they're doing is they're hitting the brakes on the economy, and they're slowing everything down. As the economy slows down, that falls into a recession. We slow down too much. So it's just like if you're trying to, slow down without stopping. The Fed wants to slow the economy down without stopping it. And that's why they've lowered the increments at which they're doing these rate hikes, and they're slowing that down because they don't want to drive us into a recession. However, usually to get the results that they want with inflation, we need at least a minor recession, or what they would call a soft landing. The problem is, the last couple of months, it looked like we were on the path to things slowing down. We were seeing spending go down. We saw inflation go down. And, the problem is that labor market, though, still very strong. And that last reading we got showed the labor market was off the charts. And if we have a lot of people making money, what that means is they're spending money. Spending money drives the economy. It drives inflation. So the Fed is trying to kind of walk this line. But what we're seeing right now is the only thing that really points us to being in a recession is what they call a negative inverted yield curve, where you've got longer term bonds that are actually paying a lower percentage than the shorter term bonds, and it's usually reversed. And we look back at the 2022 at our GDP, which even that, though, was very highly manipulated because of coming off the pandemic. So right now, we saw some signs of the economy slowing down the last couple of months, but now the report's starting to show consumer spending is up, retail sales is up, people are out there spending money, they're having fun, which is great. The problem is that that's going to keep inflation around longer. And now the Fed feels more inclined, hey, we need to go ahead and hit the brakes on this even harder. Plus, with the labor market being so strong, it gives them a little additional rope before they have to worry about hitting the end of the leash. So they can continue to do that. So now we're seeing mortgage rates that have gone up because markets are finally like, okay, we've got a strong labor market. We've got strong economic data. We're not going into a recession. The Fed is going to have to continue to push on that brake pedal harder. And that means we need to react now. And that's why rates went from, at one point they were just touching those sixes on those conventional rates, and the VA rates were well into the fives. And now they've pushed up about 0.5%, maybe even 0.75% in some scenarios.
So the people that are out there saying, oh, rates are going to come way back down, they're going to fall way down. Based on the data, it doesn't seem like that's really going to be the case anytime soon, if ever, in the near future.
Right. And I agree with you there, James, 100%. Rates are likely to hold this level or move higher. And I'm going to go back to that chart and show you guys, as long as we see expectation that the Fed is going to raise their rate. And right now that rate is looking to be at about 5.25. And as we look at July, and at that meeting, it's expected to stay around that 5.25 mark in September. Remember, just a few months ago, we were talking about September, that this rate would be at 4.5. Now they're looking at 5.25. And that 0.75% increase, it's kind of funny because it's not necessarily always the same when you look at mortgage rates, but that's why we've seen a 0.75 point increase in mortgage rates, is because of the anticipation of seeing it here. And now it looks like heading into 2024, maybe by December, they're looking, investors are saying maybe by December we'll be at 5% instead of 5.25. Whereas just a month ago, if we look here and we make this chart even fancier, we had this very light line here. We were looking at 4.5 or even 4.25. And now the dark line is where we're at today. And now we're all the way up to 5.25. So that's why the whole point of this part of that is for people when they say, hold on, James, I want to get a house, but I'm not ready yet because I think rates are going to come down. That's a hope, not a thought.
Right.
And there's nothing that I see that's going to point to rates getting significantly better from here. What about, James? You've been in the business for what, 3-4 months now?
Sorry. Yeah. Quarter of a century.
Right. So, you've been doing this for quite a while. Do you think rates are going to drop significantly from here, and why or why not?
No, they are not going to drop significantly. The cost of money was artificially too cheap during COVID and all the stuff that we went through. My entire career, I've never seen money that cheap. So what you're seeing now is a more normalization of what the market should look like. Only we were all really spoiled with thinking rates were in the 2s and the 3s, but we've never seen that. It was unprecedented time in history. Couple that with still very low inventory levels. So when you still have low inventory, there's still plenty of people wanting to buy houses and not enough houses for those people. That's another show for another day, why we're in that mess. But the reality is low inventory, the cost of money is more to help with inflation and offset that. The reality is rates are not coming down anytime soon, and the inventory is not loosening up anytime soon. So we're telling our clients who we're advising, now is the time for you to purchase right now.
Right. And that's real quick, just, what you touched on without actually saying it is, tell me that we're not in a housing bubble but not tell me we're not in a housing bubble. And that's what you just did. If for those
Correct.
of you that were listening to what James said, he said, there's still a very big inventory problem. Remember, you've got people that are sitting on mortgages in 2 and 3% range that not only do they not want to get rid of that mortgage and sell that house to take on another house at a much higher mortgage rate, they can't. I mean, you're talking a very, very significant increase. So it's like you've said before, it's a very unique time. We've got unique circumstances. Normally, when rates go up the way that we've seen, we would expect home prices to drop down, and it still wouldn't be a bubble, but we would expect to see them drop, proportionately, because we want to keep that affordability factor around the same. And this time around, that didn't happen. Home prices have come down very, very little, and more so in some markets than others. Some markets, they're still going up.
Right. And this is way different than 2008, where people like to compare it to. Because in 2008, there was a lot more inventory that was out there. There was a lot more reckless lending that was happening. So they corrected a lot of those problems. So we are definitely not in a housing bubble. We're just in kind of like the perfect storm where the cost of money is adjusted to really more of a market value. There's no quantitative easing going on or artificially keeping rates low. This is what the market is saying the money should be. And the market is going to speak crystal clear and loud. And that's where we're at today. And the inventory is completely way lower than it was in 2008. So there is no housing bubble in front of us.
Nope. So remember, if you're here live, let us know. If you're watching on the replay, give us a hashtag replay. If you have any questions, go ahead and let us know that. We'll leave you with a couple of other thoughts, because now that rates are creeping up a little bit higher, the first question that usually comes up is, well, aren't home prices going to come down? And we've just answered that. And the second one is, well, why should I buy a home now and not wait for rates to come down? And, we've talked about this before, where with rates being where they're at, tempering demand a little bit, that's helped to minimize those bidding wars. We're not seeing huge overpayments for over asking price, right? We're not seeing these. So do you think the question that everybody wants to know, there, we want some assurance, is now a good time to buy a home, James? Why or why not?
Yes, I would say home ownership is really the fabric in the community. There's many reasons for it, even forget about the tax reasons, but just that I remember when my parents got their first home, like we were living in apartments and stuff and moving here, there, and everywhere. But then also like, oh, we're settled in. This is where we're going to live. And we get ingrained in the community. It's good for your children. It's good for, your relationships. It's good to be neighborly. And what happens now is you find yourself kind of settling in, and it's good for our family life. And those are all intrinsic things other than just monetary and financial things. But the reality is, it's important to the kids to have stability, and it's important for a marriage to have stability. And home ownership does lead to that, and it is life-changing. I remember when we moved in our first house, Hammer, it was like life-changing for my parents to own that house. And we lived there all through school. I went to one school my whole life. It was great. So now's the time to buy.
My family was not in the military, but I lived more of the life of a military kid. I went to 13 schools. But that's a separate story. So anyway, though, guys, we're going to wrap it up for today. A quick recap. Rates have moved up higher. We're anticipating they could creep even a little bit higher from here. Should that slow you down from buying a home? No, it shouldn't. Remember, there are options that are likely available to you. Of course, I can't guarantee that you can refinance later. I can't guarantee that rates will come down. However, we do anticipate that as 2023 continues on, as the Fed does continue to slow the economy down, we will actually see recessionary environment at least come about, and rates will start to drop. When that time comes, you can always check into an EARL with your interest rate rapid refinance loan. Remember, you're generally there's some rules in there. You've got to go ahead and show a tangible benefit. You've got to see your rate drop significantly enough that the government says that that we're not taking advantage of you. You've got to make 6 monthly payments. You got to be, 210 days into that loan. But if you're buying a home now and rates do drop 6 months from now, that's going to put you right into that VA EARL scenario, and perfect timing. So this is, and while rates are higher is when we're going to find a couple of different opportunities where you get some home buying advantages. Also, you could talk to your lender about a seller concession and your real estate agent and talk about maybe if that's something that may be able to help you in this scenario. So got some cool options out there. Is there anything, James, that you would like to share with everybody before we wrap up today?
Yeah, make sure that there's a lot of people that jumped into the mortgage business that don't have a lot of experience. Here at Vetted VA, you go through very difficult testing. I mean, Hammer, I got an MBA, and some of the toughest exams I ever took was just to be here to serve and volunteer in Vetted VA. So when you're dealing with somebody inside Vetted VA, you can know that they're held accountable by their peers, and that the counsel that we give you is scrutinized by the community, and they're held accountable. So you can rest assured that you're in good hands if you're talking to a Vetted VA professional. You have my word on that.
Absolutely. And if you do have any questions, feel free to post them here. Otherwise, James, thanks for joining us this week.
You're welcome.
Take care, everybody.
Thanks for having me, Hammer.